Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. We bring you the information, you do your own research. And today's guest is the editor of Gold Newsletter and the CEO of the New Orleans Investment Conference, with a career spanning 4 decades in investment markets. We're going to be talking about gold and silver, as well as the miners, the broad economy, and much more. It's Brien Lundin. Welcome to the show.
Great to be with you. Thanks so much for the opportunity.
Thank you for coming on. I want to start with a broad question, as I always do at the top of the show, and that is, what are the main themes and trends you're currently watching when it comes to commodities, the broad market, and the economy that you think investors should be paying attention to?
Yeah, what we're seeing right now is a shift in the major drivers for gold. Actually, since this big rally started on March 1st, the rally was caused, a big driver at that point was central bank buying and buying by domestic Chinese. I think there was also some shifting of smart money, big portfolio allocations toward gold for kind of the same reasons that central banks were investing in gold, that being trying to insulate them from the US dollar, and recognition that we were at some point going to switch to the rate cutting side of the interest rate cycle. What's happening right now is that the broader public, most investors are now beginning to price in that next big driver, that being a Fed pivot. We thought we were going to see that pivot in as early as February of this year. And back then, the projections were the markets were pricing in 5 to 6 rate cuts this year. And those rate cuts kept getting postponed. The Fed pivot kept getting postponed. And you would have expected that the gold price, which had risen in anticipation of that factor, would have lost maybe $200 an ounce. But instead, it gained about $300 an ounce and got into a much higher trading range. And now where you see that big factor of the Fed pivot coming in, and it's really just fueling yet another rocket shot higher in gold and silver.
Fascinating. I do want to get your thoughts on the gold mining sector here as well. And if you think that they have risen sufficiently compared with the gold price. I've heard Peter Schiff, who I've spoken to on the show, has said that he believes that mining stock investors at the moment are climbing a wall of worry. They keep expecting every rally in the gold price itself to fail. And so therefore, they're not rushing into the mining stocks as much as maybe they traditionally would in a gold bull market. As we speak, obviously, yesterday, gold hit new all-time highs, still hovering around that same $2,460 level. How do you see the current performance of the miners? Do you expect them to play catch up? Obviously, we've seen some of the majors in particular perform, your Agnico Eagles, your Newmonts, Barricks, etc. How do you see the sector moving from here?
Well, Peter's right, or partly right. That's a big factor in where we've come so far. The mining investors, those that are really involved on a day-to-day basis, have been involved in the sector, have been really just hit upside the head by a 2x4 every time they gained any conviction in a market rally. And we've seen sell off after sell off and a really choppy rise over the last couple of years. That's part of the story. The other part of the story is mainstream or mining investors have never seen the factors that were driving gold earlier in the year happen before. They were confident in a Fed pivot. That's the kind of a factor or driver that they could understand and project forward by a couple of years. Once the Fed starts cutting rates, they don't stop for a long time. Or they cut rates in an emergency fashion right down to zero, which I think is going to happen at some point. But what was driving the gold price at first wasn't understood at all. Then it came out that it was central banks, and central banks were buying at such a feverish pace that investors really couldn't count on that pace continuing. And in fact, we saw that China over the last couple of months, at least publicly, has refrained from announcing any gold purchases. So understandably, the investors in the mining sector weren't willing to dive headfirst in the pool once again. Now I think that's changing. And in fact, I think it's the generalist investors that are going to start really moving at things right now, because the factor of Fed pivot, again, is something that's easily understood and projectable. We're seeing that right now. Most people aren't aware that the mining stocks, at least as rated by the big gold miner indices, had actually been outperforming gold for most of this rally, but not as much as we would have expected it to. Now that's starting to change. We're starting to see not only the big miners, but the juniors really start to move. And I think uh, what I've termed a generational window of opportunity still exists, but not for long. To get these great companies at current prices is an opportunity I think everybody needs to take advantage of while they still can.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Well, I do want to hone in on both the gold and silver mining sector a little bit later in the discussion. I would like to switch over to silver's performance at the moment. How do you rate what the silver price has been doing versus the gold price? And I wonder where you stand on the manipulation of the silver price issue. I was talking to Andy Scheckman recently. He believes that in the West, there's a collection of bullion banks that are actively suppressing the silver price. He says it's the most shorted asset in the world at the moment, or the most shorted commodity. I'm not sure exactly which. And that he thinks one of the reasons for the price suppression is actually because of silver's very understated use in wartime technology, Tomahawk missiles, and other things like that. I'm wondering where you stand on the silver manipulation side of things, because obviously some call it a conspiracy. Some say all markets are manipulated. Don't even pay attention to that. It's just noise. And your thoughts on silver's performance to date versus gold.
Yeah, I'm kind of middle of the road on the conspiracy angle. I don't think or haven't thought that gold was manipulated, as some claim, on a day by day, tick by tick basis. I think anyone who claims that it's not being manipulated is getting the whole logical argument wrong. The burden of proof is actually on anyone claiming it isn't manipulated, because it's been manipulated repeatedly, publicly, covertly, and overtly over the decades previously. The government has demonstrated, and governments have demonstrated, that they're perfectly willing to manipulate the gold price at key junctures to progress their policy positions. However, silver's kind of a different thing. You look at the custodian of the big SLV, or rather SIL, gold silver ETF, is actually SLV. I'm sorry, is J.P. Morgan, and this is an enterprise that was called a criminal enterprise by the U.S. Justice Department due to its manipulation of precious metals prices around the fix. J.P. Morgan also holds one of the biggest silver positions in the world today, if not the largest, and therefore you're never quite sure, or at least some people have raised doubts as to whether the silver in the ETFs is in the ETF or owned by J.P. Morgan, or moved, or ownership transferred at all. So it's kind of hazy subject right there. And JP Morgan and other big bullion banks are very active in the futures markets, the paper silver market, where silver is even smaller than gold in that market and therefore much more easily manipulated. If you look at the various silver price slams, one of which is going on while we're talking right now, they've all occurred between the hours of 9 and 11 in the U.S. market, the New York market. Um, and it seems to be happening again as we speak. That said, there's silver has relentlessly clung to $30 and above, and the brief instances where it's dipped below that or been driven below that, it's bounced right back up. So I think the silver story is unique in the precious metals universe. I think it's going to leverage gold, and it has always done that in this kind of a bull market, this kind of a gold bull market. I expect it to do so again, but it may do so even more explosively right now because of that structure in the market where shorts are desperately trying to defend their positions. When that dam breaks, I think we could see something really extraordinary to the upside.
And your thoughts on the US dollar? This is another topic that can be rather hyperbolic. Will it continue to be the reserve currency? We have the story of the BRICS alliance seemingly strengthening by the day. They are looking to create an alternate payment system outside of the dollar. Some say it will be backed by gold, potentially other commodities as well. Um, do you think the days of the US dollar as a reserve currency are numbered eventually? Obviously, this isn't an imminent thing that's going to happen, but do you think it could happen within the next decade?
The days are numbered, but it's an awfully big number, and I don't think it's going to happen in the next decade. I run a bit counter to my gold and silver bug compadres on this subject. I think you have to compare the U.S. dollar with all of the other available um, uh, alternatives and competitors. A BRICS currency, I think, is somewhat unworkable. It's also going to be managed by economies and governments that don't have much in the way of rule of law. And in the U.S., as much as we can criticize the rule of law in the U.S., it's still the best around. So I don't think that the U.S. dollar is going to lose its reserve currency status in any kind of a time frame that matters to us. In other words, in our investing lifetimes. However, I do recognize that there is a trend toward away from the U.S. dollar and trying to get out from under the yoke of the U.S. dollar hegemony by a number of countries, not just Russia, but also China and really central banks around the world that are buying gold quite enthusiastically right now. And in fact, the dollar's share of global reserves is falling while gold's is rising very steeply. I don't think they're going to cross at any point in time, but I think any near point in time, but I think they are going to cross eventually.
We've seen China fairly aggressively selling US treasuries while accumulating very large amounts of gold. They produce massive amounts of gold as well. I believe they're the biggest producer of gold in the world. It's widely stated that what they're reporting is actually far less than what they actually have. They're not letting the public and the world at large in on how much gold they actually possess. We're seeing other countries also kind of divert themselves away from U.S. treasuries and accumulate more gold. You mentioned the feverish buying of central banks earlier. Are we going to see, or are we seeing right now, gold replacing treasuries as kind of the new preferred risk-free asset on these countries' balance sheets?
Yeah, it is. And like I said, it's not going to replace treasuries in whole, and it's not going to assume a leadership position in foreign reserves in the near future. But you see treasuries falling, and it's a fairly steep line as a percentage of those reserves, and you see gold rising. The gold has just recently surpassed the euro as a component in foreign reserves. And it's interesting to me when you see mainstream financial media report on foreign reserves, they usually list the dollar, the euro, and the yen, and maybe a few other minor currencies, but they don't typically list gold. And that's another case of how, listening to podcasts like you, looking at the alternative media out there, you see the real story that's really being obscured by the mainstream financial media. The role of gold is rising in international finance, central bank finance, monetary policy, and that should be somewhat disturbing to the U.S. So from that standpoint, I can see some potential manipulation emerging, but I think the gold market itself has just gotten too large, and the upside momentum has gotten too great for even um, central bank forces that would be fighting against gold to manage, because most central banks now are actually buying gold.
Now, it looks like when it comes to retail participation in the physical gold market, that it's been largely driven by the East, places like China, places like India, with Western participation reported as fairly flat to down even. We're seeing outflows from ETFs. Are you seeing the same thing? And what is that catalyst that you think could bring the Western retail participation up to a higher level, and how could that impact the gold market?
Yeah, it's a unique situation. It's something we have never seen before in the history of gold as an investable asset. That history actually beginning in 1971. Previous to that, it was widely considered as money, um, and not so widely considered, but considered by me and some others at least as money since. But still, you could not invest in it. Wasn't a risk asset, an investable asset until 1971. Since then, we've had three big bull markets. But we've never seen in any of those markets, bull markets, we've never seen Asian investors, particularly Chinese investors, buy on the way up. They usually buy on price declines. They've exhibited bargain hunting characteristics in the past, and which has been helpful because it supported the gold price on price declines. But in this case, they have been buying as the price has gone up for a number of reasons that we might want to get into later. But that's a new thing. We haven't seen it before. Now we're seeing, and typically in those previous bull markets, it's been the Western investors that have bought on the way up, chased the price higher. Now we're seeing that big factor of a Fed pivot come into view, and this is bringing the Western investors in because, again, that's a trend they understand, and they're going to start chasing the price higher. The fascinating thing, and I think the exciting thing that I see, is that this doesn't mean that the Asian investors are going to stop buying. In particular, central banks, which aren't that price sensitive, may not stop buying either. So if we have Asian investors, the East buying gold, and we have the West buying gold at the same time, that's going to be something that we've never seen before. And the reaction in the gold price could be truly explosive if that develops. It may be happening literally as we speak. Over the next few weeks, we'll see more data come out as far as Asian buying, and I'm very curious to see what that's going to show. One of the reasons why Asian investors have been buying, particularly Chinese investors have been buying so heavily, is that they don't really have any alternatives. The Chinese stock market has been in the dumps. The Chinese real estate market has a number of problems that are well known. And those are the two primary investment markets of Chinese savers and investors. And they look at gold as some form of savings. That's why they buy it on price declines. They put money away and hoard it in gold. Uh, they don't have other alternatives to this. That's why they are buying or have been buying the price on the way up. They're starting to get that kind of FOMO, that investing fever for gold. And I think they don't look at, they kind of sense that the opportunity to put their money away at lower prices is fleeting. So they want to get in now.
And do you think the issues with the Chinese real estate market have also played a role in Chinese investors turning more towards physical gold, perhaps instead of real estate?
Yeah, absolutely. I think they sense that there will be some government accommodation, monetary accommodation coming up. We've already seen some moves in that direction and some plans in that direction. And they know what that means. That means, more domestic inflation. And while those policy moves will help the real estate market, the Chinese real estate market has some structural problems that even that may not alleviate. So gold is the best alternative for them to preserve their purchasing power. And they understand that well. It is, again, a cultural thing in Asia generally. And Chinese investors are socking away their available cash and liquidity in gold because they know that's going to protect them from whatever may lie ahead.
Well, let's hone in on the gold mining sector here for a moment, as well as the silver mining sector. I'm wondering where you're currently seeing the most value. Let's start with gold. Do you think the majors are still undervalued at this point? Would you look at ETFs, royalty streaming companies? Are you looking more at the developers, explorers, all of the above? Where do you think the most value lies today in the market?
Yeah, broadly speaking, all of the above. If you have the time and energy and want to devote more time and some money to learning about the junior mining sector, it's very inefficient, and you can gain advantage by just exploring it, learning about it, and trying to find the bargains that the market temporarily overlooks. However, and there's nothing wrong with that, if you don't have the ability or desire to put that kind of work in, you can simply buy the indices GDX and GDXJ, and you'll still do very well in this market. Just not as well, or not explosively well, as some of the juniors will do. But within the miners themselves, there are a few themes I think I like more than others. I think silver will outperform again, and therefore the junior silver miners and explorers and developers will do very well. That's proven to be a tried and true method of leveraging silver, which in turn leverages gold. So you're building leverage on top of leverage. I think companies with large identified resources, some of which already have economics applied to them, are going to benefit better than others, at least initially, in this bull run. One of the factors I think is coming to the fore is M&A in the sector. The major miners are starting to report their quarterlies, and we're going to get an idea of what their margins are right now. But we know that the gold price has been rising more quickly in recent months, this quarter particularly, than miners' costs have been rising. Barrick just reported today, and that proved from their quarterly filings that their costs have only risen by about 2% over the quarter, but the gold price has done much better than that. So the miners understand better than anyone else what's happening with their margins. And I think they're starting, and it's been proven out with a few recent news releases, they're starting to make big moves in the mining sector. And I think that feeding frenzy that we were hoping to develop is really imminent at this point. I think those companies, the juniors that have those big deposits, are going to be the first to go. And unlike the experiences of the past few years, where we may have buyouts at maybe a 20% price premium and half of an all-time high for a junior, that we're going to see some much better returns and buyouts and takeouts in the junior sector.
I like that you added that caveat when speaking about the juniors, that if you have the time and you're willing to, the energy, and you're willing to learn. I stay largely out of the junior mining space myself. That it will chew you up and spit you out if you don't know what you're doing. I mostly stick to the ETFs and the large producers. But for those who are willing to spend the time and devote themselves to that space, is there any insight you could give us on how you evaluate a junior mining company? Obviously, all of the typical things like management, deposit, jurisdiction, but maybe if you could let us know, what are some things that cross companies off of your list, that when you look at them, are there any initial signs that you look for, red flags? to say no instead of looking for reasons to say yes?
I think the immediate red flags come, well, in two areas: the property, the project, and the management team. If it's a management team that I have seen has not operated uh, perhaps as a good faith actor in the past, then I'll avoid that. If it's a project that has some notable flaws, then I may pass on it. Every project has some potential flaws. Uh, you know, where they're located, what regime are they in, or political regime are they in, is one of the clearest risk factors. But in some cases, the project makes up for that because it's so extraordinary, and you can see that a discount may not be may be exaggerated for a project like that. So you look at a host of characteristics for each company and each project. But at this point in my career, I know just about everybody in the industry, or know somebody who knows them very well. So I like to say I have kind of a network of spies throughout the industry, and the advantages of finding or subscribing to newsletters where people, the editors have a lot of experience in the industry, and there are a few out there that I recommend in that the free report on our website, um, is that you get advance notice of the next big things that are coming into the market. That's particularly important and advantageous in the kind of market we're going into, that is a bull market, where getting in early on a company that's with good projects, that has a management team that can really advance it and get a lot of attention from the market, that's key, and mitigates the risk in what is, let's face it, a very risky sector.
Absolutely. And I wonder how you look at jurisdictional risk as well. Are there certain jurisdictions that you just stay out of completely? Do you remain geographically diversified? Is that a way you look at of potentially mitigating risk? How do you approach that?
Yeah, if it's a great project and early on with a good management team, in many cases I won't worry about jurisdictional risk or as much. Currently, it's a target-rich environment, and I don't think you need to take undue geopolitical risk, jurisdictional risk in your investments. Some people are looking at Mexico right now and avoiding it. I don't think I'd put Mexico in that category just yet. There are some other uh, jurisdictions in Central America that I'd probably avoid right now. And simply because you don't need to accept that kind of a risk. There's great projects that are historically undervalued around the world, in North America, in Canada, the US, that I think deserve attention, and you don't need to accept that kind of pioneer risk. The pioneers, the ones that get the arrows in the back. So you don't need to venture too far afield to get really great opportunities at ideal prices.
And when it comes to vetting management for people who don't have relationships in the industry, obviously a newsletter such as yours can be an invaluable tool in that sense. But for people who are looking at the juniors and trying to gauge, maybe they don't know the past history of certain management teams, they're trying to gauge their competence. What's the best way to approach that? Is it to reach out to the IR team? A lot of these companies, the CEO's email will be on the website as well. Is it a matter of contacting the CEO? And in that sort of scenario, what are the key questions that you would ask?
Yeah, you need to do more than go through their website, because in many cases I'll look at the people behind a company on the website, and I'll look at their resumes, and they talk about all these wonderful successes, and notable by their absence are some of their failures that I'm well aware of. So you need to dig more, Google the names, look at the histories. This is where having some newsletters, subscribing to some of the better newsletters really comes into play. If you subscribe to some of the better newsletters and you see some common names among those listed in their recommendations, then you can have a bit of a better feel for the fact that someone has looked at it that's very knowledgeable about past histories. The market's evolved well, not recently, I guess over the past 10 years or so, and even more so over the last 5 years or so, and that there are some groups out there that are um, have a family of companies under their wings, common management that finds good opportunities, puts it in uh, put those opportunities in companies, assembles really good management teams, and they have a common thread. They share offices, they share some management and directors, but these are people that are putting their own money in. They've had successes in the past, and they're basically keeping it rolling and using their expertise to bring new plays to market. There's about 3 or 4 of those prominently operating in today's market, and there are other groups that only have 1 or 2 companies under their wings that do really good jobs. And it's a case of of experience and doing your homework to figure out what those are. A great way to do that is to go to conferences and talk to other investors, talk to management teams face to face, ask them what their plans are, the likelihood, what their plan Bs are, what are they going to do if things don't work out. If a project doesn't work out, which odds are it won't become a mine at least, then what's their next project? What's their next thing down the line? There's a lot to the sector, and education is a key because again, it's a very risky sector. It can be highly rewarding, especially in the kind of market we're getting into now. But it entails risk that you have to be able to handle significant losses in some positions. And when you have significant gains, you have to be smart enough to take profits as well.
When it comes to position sizing, how do you approach that? For me personally, I allocate the most capital to the least risky investments, at least on paper, the ETFs, the streaming royalty companies, the large producers. And then I'll use smaller amounts of capital as it goes down the chain. I don't really mess with the juniors. Occasionally, I'll have gambling money set aside that I might invest there. Do you look at things the same way, or do you come across certain situations where you're looking at a very small cap company that seems like it could be higher risk, but you really know the management, you really understand the company deeply, and you see a bigger opportunity, so maybe you're willing to risk more capital in that situation?
Yeah, generally speaking, and with the caveat that we can't know anyone's individual situation and therefore we can't give individualized investment advice. But generally speaking, yeah, you want to have your play money for the riskier, higher potential speculations, and you want to, if you're in the sector, you want to focus most of your capital on the more solid, less riskier uh, uh, plays. Now, all that said, there's the entire sector offers what would be regarded as a really exceptional upside potential for any other investment sector, really across the board. Now, this is one of those areas where I tell people, do as I say, not as I do, because I'm just ridiculously overweight in the juniors, because I know the sector so well. I have a good part of my personal wealth invested in it. And a big part of it is knowing the teams. I will uh, more heavily allocate towards uh, projects where I see a lot of potential in the project, and I really like the management team, and I know they're going to do the best job they know how, and they are very capable and can raise money, and all that because they have, more important than money invested in the company, they have their reputations on the line. And some of the groups I've been talking about, that's more important than money at this stage in their careers. They want to have another success. They want the market to see that they've had another big success, and they're going to make it work for the shareholders because they have their reputations on the line and they're big shareholders as well.
And when it comes to the number of positions, Rick Rule has famously said he has a service where he rates people's portfolios. And the thing he says is the biggest issue that he finds is people send him 60 companies and asked him to evaluate and said, how do you have 60 companies in your portfolio? You should only have, I think his caveat is you should only have enough companies in your portfolio that you're willing to devote at least 1 hour per month to researching and understanding that company. Are you of the same mind? Obviously, you have a ton of experience, so you're not your average investor out there. But for you personally, do you look at a more concentrated portfolio, or do you kind of have more positions diversified across the space?
Yeah, I agree with Rick. You need to be able to follow the companies. You need to be able to know what's in your portfolio. You need to know why you invested in those companies, and if that argument still makes sense at each step of the way. We do feature more companies, excuse me, in our gold newsletter portfolio for our subscribers than most investors will be comfortable in owning. But I like to do that because there's so many different flavors out there. There are investors who may love uranium. There are other ones that may shy away from it. They may love gold, but like to focus more on silver. So we like to present a larger menu to our readers. And frankly, we respect them for knowing what stories push a button for them, what they like. And we'd like to give them those options. But every company we recommend is not necessarily a company that I own, but a company that we think offers tremendous potential over the next year or so, and more potential than other plays out there.
Well, that's a great segue into the Gold newsletter. Tell us about that, what it is you do there, where people can find it, and anywhere else you want to direct people online, feel free.
Yeah, Gold newsletter is, I tell people it is the oldest precious metals advisory in the world. I think it may be the oldest investment newsletter in the world at this point. We're now in our 54th year, and we've been around a while. It was started by Jim Blanchard, my mentor and business partner in the industry, who started it in 1971. Literally on the day that Nixon closed the gold window and severed the dollar's last tie to gold. And shortly after that, a couple of years after that, after Jim was instrumental in getting gold legalized for American citizens, he had an investment conference to teach Americans how to invest in gold. And we still run that today. It's known as the granddaddy of investment conferences. It's had a long history in gold, silver, sound money, and mining stocks. And we're celebrating our 50th year this year. It is, as far as I can see, the oldest investment event in the world, longest running. So we have two great legacies that we try to burnish every day. And I urge listeners to consider these two services. You can go to goldnewsletter.com to learn all about Gold Newsletter. You can also download our free investor's guide to gold and silver there. It's a comprehensive 40-page report. It tells you everything you need to know about investing in metals and miners. And consider coming to the New Orleans conference this year for our big 50th anniversary. It's being held November 20th to 23rd. We have a number of the world's top experts in every aspect, from macro to metals to mining, and all of the markets. And you can find out more about that at neworleansconference.com.
Fantastic. Well, I'll put links in the description below to both the Gold newsletter and the New Orleans conference for people who want to check that out. Brien, this has been a fantastic conversation. I've learned so much. I'm sure the audience will as well. Thanks for coming on.
Jesse, it was wonderful talking with you. Looking forward to our next opportunity. Thanks so much.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.